Here's why a home equity line of credit is better than these 6 popular alternatives. Now, a home equity line of credit or a HELOC is like a home equity loan, but that home equity loan is backed by a percentage of the equity that you actually have in your home. However, instead of giving you access to a credit line, lenders are going to disperse the full amount to you up front. The balance plus interest and fees is then going to be split up into fixed payments over a set period of time. If you don't need that full loan amount up front, or you aren't sure how much you want to borrow yet, the HELOC can be better because it's going to allow you to withdraw funds on demand. Further, interest is only going to accrue on the amounts that you actually withdraw. HELOCs also tend to have lower monthly payments, especially during that initial draw period, which can be helpful if you want to defer that full repayment until later. While both credit cards and HELOCs offer a revolving credit line that you can use, repay, use again, HELOCs are going to offer higher credit limits and lower APRs because they're secured by your home. A HELOC and a credit card interest rates are both pegged to the Fed fund rate, but a HELOC rate can be 15 points lower on a $10,000 balance, and that's $1,500 of annual savings, according to Dan Green, the CEO of homebuyer.com. Personal loans, on the other hand, those typically come with a fixed interest rate, set term, no collateral requirements, and in most cases, the maximum loan amounts range from $50,000 to $100,000, and terms 1 year to 10. HELOCs, on the other hand, will provide you with an opportunity to borrow more money at lower interest rates for longer periods. Generally, a HELOC will be more flexible than a personal loan, and they frequently carry a lower interest rate. In my experience, people who don't own a home get a personal loan when they need money, and those who own a home use a HELOC or some similar type of financing when they're in the same financial position. But a cash out refinance is the type of mortgage that involves refinancing your existing mortgage for more than you owe and taking the difference in cash. Now, choosing whether to do a HELOC versus a cash out refi usually comes down to 2 factors: how much you need to borrow and the rate term of your current or your first mortgage. Most clients are leaning towards HELOCs right now because of the high interest rates, but that may change when rates come down. So if your first mortgage rate is, say, 4% and the HELOC is 10, then it may make sense to combine the two into one mortgage if rates end up going back to the 5s. But for now, most people keep their low rate, which their first mortgage had, and they simply add on a HELOC to that. Another option is reverse mortgages, and that's a loan product for people that are 62 or older. They own their home, and it allows them to borrow against the equity through a lump sum amount or installment payments. Lenders don't usually require repayments as long as the house remains your primary residence, but interest and fees will accrue as long as you have an outstanding balance. Again, in this situation, a HELOC can be better because you don't have to wait till you're 62, and it allows you to borrow on an as-need basis. Plus, they aren't really designed to permanently reduce your home's equity. And the last thing, payday loans. If you have less than perfect credit, you might consider doing like a payday loan. However, they're relatively small and very expensive. Some states even deemed them predatory and illegal. If you own your home and you have enough equity, in this situation, a HELOC can absolutely offer a better solution. HELOC lenders often have flexible eligibility requirements like payday lenders, but offer larger loans, lower interests, and longer repayments. So, do you think a HELOC is right for you? While HELOCs offer some clear advantages, they also have a few potential downsides. That first and foremost, lenders offer all of the above benefits in exchange for a lien on your home. And that means if you don't make all your payments on time, your home could go into foreclosure. As a result, it's important to always be super confident that you're going to be able to make those HELOC payments on time and as agreed upon. HELOCs can also come with a ton of upfront fees that increase your borrowing costs. Although some lenders, they can waive them To get the best deal, be sure to shop around, compare factors like loan amounts, eligibility requirements, fees, repayments, periods, and interest rates. So my name's Tyler Carlson with Carlson & Co. Real Estate. Thanks for stopping by, checking out our page, Living Spokane CDA. If checking out a HELOC is right for you and you want recommendations, who to talk to, go ahead and reach out. You can shoot us a message, like, share, and I'll see you on the next one.